Assalamualaikum warahmatullah. Welcome back to Sada Education. We were earlier talking about the sale price which is disclosed in our murabaha financing, because murabaha financing is based on sale. It is not a loan, and therefore in the terms of the contract, the sale price must appear in the contract. So, for example, we look at a murabaha facility of $200,000 with a profit rate at 5% per annum and a tenure of 5 years. So we can see that the profit margin generated from this facility is the facility amount of 200,000 multiplied by 5% multiplied by 5 years, and we got a profit margin of 50 million. And therefore, the sale price would be the sum of the facility plus the profit margin, and that would be equal to $250,000. So the borrower or the customer owe the bank actually $250,000 to be paid over 5 years. So it is like taking a facility of $200,000, but when we add on the profit margin, then the total money that the customer owed the bank over 5 years would be $250,000. So like a loan, when the bank gives a loan of $200,000 at 5% interest rate per annum over 5 years, then the interest income would be 50,000. Then the debt, the total debt is the loan amount plus 50,000, and that would be 250K. But then that is a loan contract whereby there is no mentioning of a sale price or selling price, because in a loan there is no sale, there is no transaction involving an object, and therefore the sale price is irrelevant. But for Islamic financing, where we are using the contract of sale or adbai, and therefore the sale price or selling price must appear in the agreement. And then in order to arrive at the selling price, then we need to know what is the profit rate, right? The profit rate is basically the rate that the bank would charge on the facility amount. So it doesn't mean that when Islamic Bank is an interest-free bank, it doesn't mean that all money acquired from Islamic Bank are free from interest, meaning that the borrower will have no worry about a cost of borrowing. That's a misconceived idea about Islamic banking. That Islamic banking, when we use sale by deferred payment, we still have to pay the finance charge for the facility use, but that is called the profit margin, based on the profit rate that were set up by the bank to indicate the credit profiling of the borrowing party. So the profit rate, for example, if you look at the equation here, the profit rate is a sum of the cost of fund plus overhead plus a certain spread that will cover credit, market, and operational risk. So when we come in to use Islamic banking facilities, even though it says it is interest-free banking, it doesn't mean that the customer who use Islamic product will not pay any finance charges. So that is a misconception. They do still have to pay the finance charge because the bank is incurring cost of fund. The bank also incur overhead expenditure that must be fully paid or fully recognized in the charging of profit. But then we would like to see, we would like to see how is the profit rate determined or set up in Islamic banking, because we often see that currently that the prevailing interest rate is set against the interest rate in conventional banking. So Islamic banks set their profit based on the prevailing level of interest rate. So there is this, this idea that the Islamic bank profit rate, which is the finance charge, can be benchmarked against interest rate because the interest rate is the price of credit, and the Islamic bank is also running a business of credit finance or debt financing, and therefore it is all right to benchmark the price of the sale facility to the price of the lending facility. But then what they were saying is that the sale facility is not a loan. They are just benchmarking the profit rate against the interest rate, but then the nature of the sale is still a sale. It will not be converted into a loan, and therefore that seems to be the logic behind the setting up of profit rate based on interest rate. But for me, I think that this is a logical thing to do. But that is not based on what they have argued. My thinking is that this is something that is logical, since the risk in the murabaha or the risk in tawarruk are similar to the risk in the interest-bearing loan. And we can see that the murabaha and interest-bearing loan, both of them face credit, market, and operational risk. So when their risk profiling are similar, then the profit rate can be set against interest rate, right? Because this is basically an apple for an apple, and therefore when the risks are similar or equivalent, then the pricing should be similar also, right? But however, there's a caveat here. If the murabaha carry ownership risk, then the risk profile of murabaha are now different from that of riba loan, as this loan do not carry ownership risk. Because a riba loan is an IOU, it is a lending and borrowing contract, and there is no object traded in a lending contract. So there is no ownership risk appearing in a loan, and therefore when the murabaha carry ownership risk by virtue that it is a sale, then the murabaha cannot be benchmarked against interest rate, because the risk profiling of murabaha with ownership risk are now different from the risk profiling of interest-bearing loan, right? And this is where we will deviate from the current practice, and therefore we should be able to be very careful in order to justify why profit rate can be benchmarked against interest rate. Finally, there is no evidence today that Islamic banks are holding the ownership risk of the object they sold to customer. They do so to avoid high capital charges accorded to the object owned by the bank, intended for resale on credit term. So Islamic bank today, due to the fact that if they were to hold the object on their banking book, this would be a dangerous position, because the value of the object may deflate or may decline due to market forces. Then the bank would suffer a loss if there is a decline in asset value, and therefore the risk associated with ownership of goods on the banking book is very high, and Islamic banks are required to hold high amount of capital in order to conduct such transaction, where they have to hold ownership risk, and therefore most Islamic banks would avoid taking ownership risk, and that is why most of the murabaha and most of the tawarruk, all of the tawarruk are basically similar to a loan, because the murabaha or the tawarruk do not carry ownership risk, and therefore right now most of these products, the profit rate of which are set against interest rate. All right, so that's it for today. We will further look into this matter as we move along. So thank you very much. Don't forget to share and to comment and to subscribe. Assalamualaikum warahmatullahi. Thank you.